Close your eyes. In January 2023, on the second day of the new year, an open letter appeared on Twitter. It was addressed to Barry Silbert, the chief executive of Digital Currency Group, one of the largest cryptocurrency conglomerates ever assembled. The letter was written by Cameron Winklevoss, one of the twins who had famously fought Mark Zuckerberg over the origins of Facebook, had become Bitcoin billionaires, and had built Gemini, a regulated cryptocurrency exchange. The letter was not polite. It accused Silbert and DCG of bad faith, of dragging their feet on negotiations to make investors whole, of knowing about a financial hole and concealing it. The letter demanded Silbert's resignation. The financial hole at the center of the dispute was enormous. Genesis Global Capital, a cryptocurrency lending company owned by DCG, had frozen withdrawals in November 2022 in the immediate aftermath of FTX's collapse. Frozen inside Genesis were approximately $3 billion in funds belonging to creditors, including roughly $900 million that belonged to ordinary retail investors who had deposited money through Gemini's Earn program, a product that promised yield on cryptocurrency holdings and that had, without many of those investors fully understanding, channeled their funds directly into Genesis. The story of how Genesis got here, of how one of the most prestigious and well-connected companies in the cryptocurrency industry came to owe billions of dollars it could not pay, runs through some of the most consequential events in cryptocurrency's history. The collapse of Three Arrows Capital, the collapse of FTX, and a web of institutional relationships, intercompany loans, and optimistic accounting that had held together through the bull market and came apart, all at once when the bear market arrived. The human dimension of this story centers on a class of victims specific to cryptocurrency's institutional evolution. Retail investors who had reached for professional quality products and found themselves subject to the risks of institutional counterparties they had never directly chosen and never fully understood. The gap between what those depositors believed they were doing, earning yield on their savings through a regulated exchange, and what was actually happening to their money was not a gap they had crossed willingly. It was built into the product's architecture, invisible in the bull market, and suddenly, catastrophically visible when the bear market arrived and the money stopped moving. There is also a story here about what the word institutional meant in cryptocurrency in the 2020-2021 period, about the prestige networks, the brand affiliations, and the regulatory identities that made products look safer than they were. DCG was not a fringe operation. Genesis was not a startup. Gemini was not an unregulated exchange. The combination of those three names should have produced something solid. That it produced a $3 billion hole in a bankruptcy filing is the question this story attempts to answer. Digital Currency Group was founded by Barry Silbert in 2015. Silbert was a former investment banker who had become one of cryptocurrency's most prominent institutional advocates. He had founded Second Market, a platform for trading shares in private companies, which he sold to NASDAQ in 2015. He had been an early and vocal investor in Bitcoin at a time when institutional investors were still largely treating the asset with skepticism. DCG was built to be the institutional infrastructure of the cryptocurrency industry, not a cryptocurrency company in the narrow sense, but a holding company that owned and invested in the companies that made the industry function. DCG's model was deliberately designed to benefit from the growth of the cryptocurrency industry as a whole, rather than from a single product or service within it. By owning the news organization, the investment vehicle, and the lending operation, DCG captured value across multiple points in the institutional cryptocurrency ecosystem. This diversification was a strength in the bull market. When every segment of the industry was growing, DCG's portfolio was growing across all of them simultaneously. It was also a vulnerability when the bear market arrived, because the interconnections between the portfolio companies meant that stress in one part of the ecosystem could transmit directly into stress in another, and DCG's exposure to that stress was concentrated rather than diversified. The portfolio DCG assembled was a map of the cryptocurrency ecosystem at its most ambitious. It owned CoinDesk, the leading cryptocurrency news publication. It owned Grayscale Investments, which ran the Grayscale Bitcoin Trust, the largest Bitcoin investment vehicle accessible to traditional investment accounts, the product through which billions of dollars of institutional capital had first found its way into Bitcoin exposure. It owned Luno, a cryptocurrency exchange with significant presence in Africa and Southeast Asia. And it owned Genesis. Genesis had begun as a trading desk and evolved into a lending operation. In the world of cryptocurrency, lending played a role that was structurally important and structurally hazardous. It allowed holders of cryptocurrency to put their assets to work, earning yield, while borrowers used those assets for trading, arbitrage, or other investment strategies. The lender received yield. The borrower received leverage. The arrangement worked as long as the borrower remained solvent, the collateral retained its value, and the lender's risk management was adequate to handle the circumstances when those conditions broke down. Genesis became the counterparty of choice for sophisticated cryptocurrency traders and institutional borrowers. Its reputation was built on the prestige of the DCG affiliation, on the quality of its relationships throughout the industry, and on years of apparently successful operation through multiple market cycles. It had weathered the 2018 bear market. It had grown substantially through the 2020-2021 bull run, as demand for cryptocurrency leverage increased alongside prices. By late 2021, Genesis was one of the largest and most trusted names in institutional cryptocurrency finance. The specific nature of Genesis's business, over-the-counter lending and borrowing, conducted through bilateral agreements with institutional counterparties, gave it a different risk profile from a regulated bank or broker-dealer, and different disclosure obligations as well. Genesis was not a bank. It did not have deposit insurance. Its creditors were not protected by any regulatory backstop. The loans it made and received were governed by the specific terms of individual agreements with individual counterparties, not by the standardized framework that banking regulation imposes. This meant that the quality of Genesis's risk management was not subject to external examination in the way that a bank's would be, and the adequacy of that risk management was not something that creditors could verify from the outside. They relied on Genesis's reputation, on DCG's backing, and on the terms of their individual agreements. The Gemini Earn program was a product that Genesis made possible, though it appeared to retail investors primarily as a Gemini product. Gemini was the exchange built by Cameron and Tyler Winklevoss, a regulated entity with a reputation for compliance and institutional quality. The Earn program offered retail investors the ability to earn yield on their cryptocurrency holdings, to deposit funds and receive interest, rather than simply holding assets in a wallet. The yield came from Genesis, which took the deposited funds and deployed them in its lending operations. Earn customers were effectively becoming Genesis creditors through the Gemini interface, though the structure was not always transparently communicated. The yield that Earn customers received was not generated from thin air. Genesis deployed those funds into its lending book, extending capital to hedge funds and trading desks that paid interest for the use of that capital in their own strategies. The chain ran from retail depositors through Gemini's interface, through Genesis's loan portfolio, to institutional borrowers leveraging those assets in cryptocurrency markets. At each link, some value was retained as margin. The retail depositor at one end received a fraction of what the institutional borrower at the other end paid. The difference represented the intermediary's margins, and it worked as long as the borrowers remained solvent and the collateral retained its value. What earned customers typically did not understand, and what Gemini's marketing of the product did not always prominently disclose, was that the yield they received came with commensurate risk. If the institutional borrowers who deployed their funds could not repay, if the collateral backing those loans declined in value faster than the loans could be unwound, the losses would travel back through the chain. Genesis would absorb them first. If Genesis could not absorb them, they would reach the depositors. The yield was real during the bull market. The risk that made that yield possible was also real throughout. It was simply not visible until the market conditions changed and the chain had to reverse. The cryptocurrency lending market of 2020 and 2021 operated in a regime of extraordinary abundance. Prices were rising. Demand for leverage was high because borrowing Bitcoin to buy more Bitcoin, or borrowing stablecoins to deploy in yield farming strategies, or constructing complex arbitrage positions using borrowed capital. All of these strategies were profitable in a bull market. Companies like Genesis, Celsius Network, BlockFi, and Voyager Digital competed for borrowers and lenders, offering increasingly attractive terms as the market grew. The yield that retail investors could earn by depositing cryptocurrency into these platforms rose as the platforms competed for capital to deploy in an ever more active lending market. Genesis sat at the institutional tier of this ecosystem. Its clients were hedge funds, trading desks, family offices, and sophisticated investors. Not primarily retail participants, but the professional counterparties that retail-facing platforms like Celsius and BlockFi in turn relied on for their own yield generation. Genesis was the wholesale layer of a market that had retail investors at one end and highly leveraged professional trading at the other. The specific importance of Genesis's position as the wholesale layer was that it created a concentrating effect on the industry's risks. Individual retail-facing platforms, Celsius, BlockFi, Gemini Earn, each had their own retail depositor bases, but many of them channeled a significant portion of their deposited funds into the same institutional borrowers through the same Genesis lending conduit. The diversification that retail depositors might have assumed from using different platforms was, at the institutional wholesale level, substantially less than it appeared. Multiple platforms were lending to the same set of institutional counterparties, with Genesis as the common intermediary through which much of that capital flowed. When Three Arrows failed, the losses did not just hit Genesis. They hit every platform whose yield generation had depended on Genesis's loan book, all at the same time, through the same channel. The risks embedded in this structure were visible, in retrospect, to anyone who looked carefully at the institutional interconnections. The yield that retail investors earned by depositing with Earn, or with Celsius, or with BlockFi ultimately came from borrowers who were using those funds to trade cryptocurrency. If cryptocurrency prices fell sharply and borrowers found themselves unable to repay, or if the collateral backing the loans fell in value faster than the loans could be wound down, the entire chain of obligations could transmit losses from the trading desks at one end to the retail depositors at the other. The cryptocurrency lending market of 2021 was a system of interconnected obligations that had never been stress-tested by a serious and sustained bear market. There was a second structural feature that amplified the risk: the opacity of cross-counterparty exposure. Genesis lent to Three Arrows Capital, Celsius lent to Three Arrows Capital, Voyager lent to Three Arrows Capital. BlockFi had its own exposure, but no single lender had visibility into the total magnitude of Three Arrows' borrowings across all of these platforms simultaneously. Each lender knew their own exposure and the collateral posted for that exposure. None of them knew the full picture. When Three Arrows began to fail, what appeared to each individual lender as a manageable position was in aggregate an unmanageable one, a discovery that arrived simultaneously when the fund began defaulting across multiple relationships at once. The bull market had papered over a fundamental credit analysis problem: the absence of any mechanism through which cryptocurrency lenders could assess the total leverage of a single borrower across the entire industry. Traditional credit markets had developed credit bureaus, syndicated loan registries, and cross-default clauses precisely because lenders needed to understand their exposure to a borrower in the context of that borrower's entire financial picture. The cryptocurrency lending market of 2021 had replicated the lending functions of traditional credit without replicating the information infrastructure that made responsible lending possible. Genesis, at the institutional wholesale layer of that market, was positioned to absorb the consequences of that gap more directly than any other participant. The first serious stress test arrived in June 2022. Three Arrows Capital, a Singapore-based hedge fund that had been one of the most prominent and apparently successful cryptocurrency investment funds in the world, collapsed. Three Arrows had been a major borrower across the lending market, borrowing hundreds of millions of dollars from Genesis, from Celsius, from Voyager, from dozens of other counterparties. When the cryptocurrency market began falling in May 2022, and Three Arrows' highly leveraged positions were liquidated, the fund could not repay its debts. Genesis lost approximately $2.4 billion in exposure to Three Arrows Capital, a loss of extraordinary magnitude for a lending operation of any kind, and a loss that exceeded Genesis's equity by a substantial margin. DCG stepped in to support Genesis. It issued a promissory note to Genesis, a commitment to repay $1.1 billion over 10 years. The promissory note allowed Genesis to represent to creditors and the public that the Three Arrows losses had been addressed, that Genesis was capitalized, and that operations would continue normally. The promissory note was real, in the sense that it was a genuine commitment from DCG. But it was not cash. It was a 10-year obligation from a parent company to its subsidiary, and its actual value depended entirely on DCG's ability to make good on that commitment over a decade, in which a great deal could change. The structure of the promissory note reflected the specific constraints DCG was operating under in the summer of 2022. DCG's assets, Grayscale, CoinDesk, dozens of portfolio companies, were substantial on paper but not easily liquidated. Raising the full cash value of the Three Arrows exposure in the immediate aftermath of the collapse, in a bear market in which cryptocurrency asset prices had fallen dramatically, would have required selling assets at deeply pressed prices. The promissory note was a mechanism for spreading that financial obligation over time, allowing DCG to honor it from future cash flows rather than a single immediate liquidation. From DCG's perspective, this was a genuine and reasonable response to a genuine and difficult situation. From the perspective of Genesis's creditors, it was an obligation whose present value was substantially less than its face value, and whose existence allowed Genesis to continue operating and accepting new lending while carrying a balance sheet hole that the note had not truly filled. In early November 2022, FTX collapsed. The details of FTX's implosion, the intercompany loans to Alameda Research, the misuse of customer funds, the rapid unraveling that took one of the world's largest cryptocurrency exchanges from apparent solvency to bankruptcy in less than a week, belonged to their own story. What mattered for Genesis was that FTX had been a significant counterparty in the cryptocurrency lending market, and that Genesis had exposure to Alameda Research, FTX's affiliated trading operation. When Alameda collapsed along with FTX, Genesis faced a second major loss in the same year, coming on top of the Three Arrows losses that had already stressed the company's balance sheet beyond its equity. The timing of FTX's collapse in November 2022, just 5 months after the Three Arrows crisis, gave Genesis no time to repair its balance sheet between the two shocks. The DCG promissory note had provided a bridge, but it was a bridge to a future in which DCG would have time to generate the cash to honor it. FTX collapsed before that future had time to materialize. The second loss arrived while Genesis was still structurally weakened by the first, in a market that had continued to decline through the summer and fall, eroding the value of every asset on Genesis's books, as well as the collateral backing its outstanding loans. The combination of the two losses, Three Arrows in June, FTX in November, left Genesis in a position from which there was no exit that did not involve a formal restructuring of its obligations. On November 16, 2022, 8 days after FTX filed for bankruptcy, Genesis Global Capital suspended redemptions and new loan originations. The announcement was carefully worded, but the meaning was clear. Genesis could not return client funds on demand. The $3 billion hole in Genesis's balance sheet, the accumulation of the Three Arrows losses, partially covered by the DCG promissory note, plus the new FTX exposure, was larger than Genesis could fill without either new external capital or a restructuring of its obligations. Neither option was immediately available. The doors closed. For the investors in Gemini Earn, the news arrived as a shock. Many of them had not understood, had not been clearly told, or had not fully absorbed that their Earn deposits were channeled to Genesis. They had understood themselves to be depositing funds with Gemini, a regulated exchange with a reputation for compliance and consumer protection. The discovery that those funds were now frozen inside a separate lending company they had never directly contracted with, subject to Genesis's bankruptcy proceedings rather than any regulatory protection for exchange customers, was disorienting. The Winklevoss twins had built Gemini's reputation on regulatory compliance. The Earn product had created an exposure that reputation could not protect against. For many Earn customers, the specific shock was the realization that their funds were not simply in a temporary holding pattern while the platform processed withdrawal requests. They were frozen inside a separate legal entity, Genesis, which was itself insolvent. The funds were not delayed. They were lost, or potentially lost, in a way that could only be resolved through a bankruptcy process that would take months or years and return an uncertain fraction of what had been deposited. The practical experience of logging into the Gemini app and discovering that the Earn option no longer offered withdrawals was the moment when the institutional architecture behind the product, invisible during the years when it was functioning, became suddenly personally visible. The negotiations that began immediately after the freeze pitted Genesis's creditors, including Gemini, representing the $900 million in Earn customer funds, and dozens of other institutional lenders, against Genesis and DCG. The central question was what DCG owed Genesis, over and above the promissory note it had already issued, and whether DCG was prepared to contribute additional capital to make Genesis creditors whole, or whether the shortfall would have to be resolved through a bankruptcy process. Barry Silbert's position was that DCG had already made a substantial commitment through the promissory note, and that any additional contribution would need to be negotiated through a formal process. The creditor's position was that the promissory note had been structured to make the whole look smaller than it was, and that DCG bore a greater moral and legal responsibility for Genesis's condition than it was acknowledging. Cameron Winklevoss emerged as the most publicly visible voice for the creditor side of this dispute. His strategy, in contrast to the private negotiation that most institutional creditors pursued in distressed debt situations, was to conduct the conflict publicly. The open letter on January 2, 2023, was not primarily a legal document or a negotiating position. It was a public accusation and a demand designed to create reputational pressure on Silbert and DCG that private negotiations had not produced. It named Barry Silbert. It accused him of bad faith. It demanded his resignation. It told the story of earned customers, retail investors who had deposited their savings through a product that Gemini had marketed, and framed the dispute not as an institutional creditor negotiation, but as a consumer protection issue. The choice to go public was a calculated strategy, but also a reflection of genuine frustration. Gemini was responsible, in a meaningful sense, for the $900 million in earned customer funds that were now locked inside Genesis's bankruptcy. Gemini had marketed the product. Gemini had channeled the deposits. Gemini's regulated reputation had given customers confidence. Cameron Winklevoss's public campaign was not just a negotiating tactic against Silbert. It was also Gemini's own attempt to demonstrate that it was fighting for its customers, that the institutional failure that had produced the crisis was not a Gemini failure, that Gemini was on the customer's side, rather than the side of the institutional parties who had caused the problem. On January 12, 2023, the Securities and Exchange Commission charged Gemini and Genesis with the unregistered offer and sale of securities through the EARN program. The timing, 10 days after Cameron Winklevoss's public letter and a week before Genesis filed for bankruptcy, was not accidental. The SEC's position was that the EARN product was a security, that its yield was derived from the deployment of customer funds in a way that made investors dependent on the entrepreneurial efforts of Genesis, and that both Gemini and Genesis had offered this product to retail investors without registering it as a security or complying with securities law disclosure requirements. The charge applied to both companies, which meant that Cameron Winklevoss's public campaign against Barry Silbert and DCG was occurring in the same regulatory environment that also held Gemini potentially liable for the EARN product it had marketed. On January 19, 2023, Genesis Global Capital filed for Chapter 11 bankruptcy protection in the Southern District of New York. The filing listed approximately $5.1 billion in liabilities, the total amount Genesis owed to its creditors, against assets that were substantially less. The creditors included institutions that had lent to Genesis directly, retail investors through the EARN program, and various counterparties across the cryptocurrency lending ecosystem. The bankruptcy process would determine how those claims were prioritized, what assets were available to satisfy them, and what fraction of what was owed each creditor would ultimately receive. The bankruptcy proceedings immediately became complicated by the relationship between Genesis and its parent company DCG. The central contested question was the value and terms of the promissory note that DCG had issued to Genesis after the Three Arrows losses. Creditors argued that the 10-year promissory note had understated the effective loss, that an obligation to repay $1.1 billion over a decade was worth significantly less than $1.1 billion in present value terms, and that the way the note had been structured allowed DCG to present Genesis as better capitalized than it actually was. DCG maintained that the note was a genuine commitment it intended to honor. The dispute about the note's value and terms was central to the negotiations that would determine how much creditors received. The accounting question embedded in the promissory note was not merely technical. It went to the heart of whether creditors who had continued lending to Genesis after the Three Arrows losses had done so with adequate information about the company's true financial condition. If the promissory note was worth, in present value, substantially less than its face amount, and standard financial analysis of a 10-year, non-interest-bearing note would discount it significantly. Then Genesis's balance sheet, as represented to creditors after June 2022, was misleadingly optimistic. Whether that misrepresentation rose to the level of fraud, or whether it represented the aggressive but legal accounting that companies in distress often employ, was a question for investigators and ultimately for courts. Barry Silbert responded to Cameron Winklevoss's public attacks in letters of his own, disputing the characterization of DCG's conduct and questioning the motivations behind the public campaign. The exchange between the two became one of the most public institutional disputes in cryptocurrency history. Two prominent figures who had both been major forces in building the institutional cryptocurrency industry, now attacking each other in public statements about who was responsible for billions of dollars in losses. The fight had the quality of a family argument made public. The cryptocurrency industry, which had long presented itself as a unified alternative to traditional finance, was exposing the conflicts and misalignments of interest that had always existed beneath the surface. The Genesis bankruptcy was being processed through the Southern District of New York, while simultaneously, throughout 2023, DCG was trying to manage its own financial position in the aftermath of the crisis. DCG's portfolio was substantial. The combined value of its holdings in Grayscale, CoinDesk, and dozens of other portfolio companies represented enormous paper wealth. But paper wealth is not liquid, and the specific problem DCG faced in 2023 was a liquidity problem. Obligations coming due, or likely to be found due as part of the Genesis bankruptcy settlement, against assets that could not be quickly or easily sold without further damaging the value of the portfolio. The resolution of the Genesis case required DCG to make meaningful financial commitments, not merely maintain the existing promissory note, but potentially contribute additional capital. And assembling that capital required either selling assets or raising new money in a market that had been badly damaged by the events of the preceding year. CoinDesk, DCG's news publication, was put up for sale in 2023 as part of DCG's effort to raise capital. The sale of CoinDesk was symbolically significant. DCG was the parent of the most prominent media organization covering the industry it was itself part of, and the conflict of interest this created had been a recurring subject of industry criticism. The sale also demonstrated the practical constraints DCG was operating under. It was monetizing portfolio assets to meet its obligations. The CoinDesk sale process itself became a story within the Genesis crisis story. Potential buyers, including several major media companies and cryptocurrency-adjacent investors, evaluated CoinDesk's value in a market environment where the cryptocurrency industry's credibility had been seriously damaged by the events of 2022. The publication that had broken the Alameda balance sheet story, the report that had triggered the FTX collapse, was now being sold by a company whose own subsidiary had contributed to the same crisis. The irony was not lost on industry observers. CoinDesk's journalism had maintained editorial independence from DCG's business interests through the crisis, and that independence was both part of its value proposition to buyers and a complication for a parent company whose interests the journalism had sometimes directly challenged. The creditors' committee in the Genesis bankruptcy proceedings pursued an aggressive negotiating position throughout 2023. The committee included institutional creditors who had lent significant sums directly to Genesis, alongside the representation of earned customers whose claims came through the Gemini product. The negotiations over how the DCG promissory note would be valued and whether DCG would make additional contributions were central to every proposed restructuring plan the parties considered during the year. Each proposal was rejected by one or more constituency of creditors as insufficient. The bankruptcy proceedings moved through the slow machinery of Chapter 11, creditor votes on proposed plans, court hearings on contested issues, modifications, and new proposals, without reaching a final resolution through most of 2023. The SEC charges against Gemini and Genesis created an additional dimension to the proceedings. Gemini was working to reach a settlement with Genesis creditors on behalf of earned customers, while simultaneously defending itself against the SEC's unregistered securities charges. The Winklevoss twins had staked Gemini's identity on regulatory compliance, and the earned product's legal status under securities law was a direct challenge to that identity. The SEC charges did not stop the bankruptcy proceedings, but they added another legal front that both Gemini and Genesis had to navigate simultaneously. The irony of the SEC charges was not lost on observers of the cryptocurrency industry. Cameron Winklevoss had invested heavily in regulatory compliance, specifically to build Gemini into the kind of company that could offer products to retail investors with confidence. The SEC's position that the earned product was an unregistered security, that it should have been registered and disclosed under securities law, with all the prospectus requirements and investor disclosure standards that entailed, was a challenge to the specific judgment that Gemini had made in structuring the product through Genesis rather than a registered vehicle. Whatever the merits of the legal argument, the charges placed Gemini in the position of having to defend its compliance posture while simultaneously trying to demonstrate that posture to the earned customers who were watching. For the retail investors who had deposited funds through Earn, the bankruptcy proceedings were remote from their daily experience in the same way that most legal processes are remote from the people they affect most directly. They had deposited money through an app. The money was gone. Not confirmed stolen, not confirmed lost, but inaccessible, held inside a legal process they had not chosen and could not control, moving on a timeline determined by court schedules and negotiating dynamics among sophisticated parties with their own interests. The uncertainty was its own form of harm. The inability to plan, to know whether recovery was coming and in what amount, to close the chapter that had been opened by a product marketed as a straightforward way to earn yield on savings. In November 2023, Genesis and its creditors reached a restructuring agreement in principle. The agreement involved a settlement of the claims against DCG and the terms under which DCG's obligations to Genesis would be satisfied. DCG agreed to contribute assets, including cryptocurrency holdings and other portfolio assets, to help fund the recovery for Genesis creditors. The precise terms of the DCG contribution were the result of many months of negotiation and reflected the fundamental tension throughout. DCG wanted to preserve its portfolio and its ongoing operations. Creditors wanted the maximum possible recovery from the entity that had stood behind Genesis. The agreement represented a compromise between those positions. Separately, Gemini reached its own agreement with the Genesis creditors to address the earned customers' claims. Gemini contributed additional funds to improve the recovery for earned customers, acknowledging, without fully conceding, that the way the earned product had been structured and marketed had created obligations that extended beyond the strict legal minimum. The earned customer recovery, in the eventual settlement, was expected to include some recovery of the deposited funds, though the precise percentage remained dependent on the overall recovery in the bankruptcy proceedings. The bankruptcy plan that emerged from the restructuring agreement went through the court confirmation process in late 2023 and was confirmed by the bankruptcy court in early 2024. The confirmation marked the formal end of the Genesis bankruptcy proceedings, not the end of the distributions to creditors, which would continue as assets were liquidated and proceeds distributed, but the legal conclusion of the process that had determined how those distributions would occur. The path to confirmation had required navigating genuine conflicts of interest among the creditor constituencies. Institutional creditors who had lent directly to Genesis and retail earn customers through Gemini had different priorities and different views of how the available assets should be allocated. The creditors' committee, which represented both groups, had to develop a plan that could obtain enough votes from each constituency to pass confirmation thresholds. The confirmation of the plan in early 2024 was, in this sense, not just a legal conclusion, but a demonstration that the bankruptcy process, slow, expensive, and contested, could produce a resolution when the parties had sufficient assets to distribute and sufficient incentive to agree. Barry Silbert remained at DCG through the entire process. The resignation that Cameron Winklevoss had demanded in his January 2023 letter did not happen. The public dispute between the two men, which had continued through much of 2023 in intermittent exchanges, did not produce the personal outcome Winklevoss had sought. What it had produced was a public record of the dispute and the dynamics that had led to it, and a resolution of the financial crisis that left both DCG and Gemini diminished but continuing to operate. The fact that Silbert did not resign, that the founder of DCG weathered the most public and sustained institutional criticism in the cryptocurrency industry's history and remained in his position, was itself a data point about how institutional accountability worked in an industry without the shareholder activism or proxy vote mechanisms that might, in a publicly traded company, produce a different outcome. DCG was a private company. Its shareholders were Barry Silbert and the investors who had backed the holding company. The public pressure that Cameron Winklevoss was trying to create through his letters and social media campaign was a substitute for the formal governance mechanisms that would have applied in a different institutional context. When those formal mechanisms were absent, public pressure alone was insufficient. The DCG that emerged from the Genesis crisis was a smaller and more constrained organization than the one that had entered it. Assets had been sold, the portfolio had been reduced, the reputational standing that DCG had built over years as the most substantial institutional cryptocurrency conglomerate had been damaged by the association with billions in losses and a very public internal dispute. Grayscale remained the most valuable asset in the portfolio, and its legal victory in forcing the SEC to allow conversion of the Grayscale Bitcoin Trust into an exchange-traded fund, a victory that came in August 2023, provided DCG with a significant asset that had survived the crisis and increased in value. The Genesis collapse and its resolution revealed something that had been structurally present in cryptocurrency lending from the beginning, but had not been visible until the market stress of 2022 made it undeniable. The cryptocurrency lending ecosystem of 2020 and 2021 had been built on a set of circular relationships and optimistic assumptions that were invisible in the bull market and catastrophic in the bear market. Genesis had lent billions to Three Arrows. Three Arrows had lent money to other funds and protocols. Celsius had channeled retail deposits into yield strategies that depended on platforms like Genesis. BlockFi had done the same. Voyager Digital had lent to Three Arrows. The collapses radiated outward from Three Arrows through this network of mutual obligations, and then FTX's collapse sent another wave through what remained. Genesis was the point where those waves intersected most visibly. The promissory note that DCG had issued to Genesis in the summer of 2022, after the Three Arrows losses, became in retrospect the central document of the crisis. It had allowed Genesis to represent itself as capitalized at a moment when its actual equity was deeply negative. The question of whether that representation was misleading, whether creditors who had continued lending to Genesis after the Three Arrows losses had done so with adequate disclosure of the company's actual financial condition, was one of the contested legal and moral questions of the entire proceeding. It was a question about what disclosure means in an industry that had grown faster than the regulatory frameworks governing what companies had to say about their financial condition. The Genesis case was also a lesson about what institutional affiliation actually guarantees. DCG's ownership of Genesis had been, in the lending market, an implicit endorsement of Genesis's financial strength. The presumption that a parent company would not allow its subsidiary to fail, that the DCG brand conveyed a level of backing that the subsidiary's own balance sheet might not. This assumption was not unreasonable. Parent company support is a meaningful factor in traditional credit analysis. But the support that DCG provided, a 10-year promissory note from a private company whose own liquidity was constrained, was materially different from the cash capital injection that the assumption of parent support had implied to creditors. The gap between the implied guarantee and the actual terms of support was a gap that the crisis made irreversible. For ordinary investors who had used the Gemini Earn product, the lessons were specific and practical. A product that promises yield on cryptocurrency deposits is not a savings account. It is not insured. The yield comes from somewhere, from borrowers who borrow the deposited funds for their own purposes. And if those borrowers fail, the loss can travel back through the yield product to the original depositor. The sophistication of the institutional intermediaries through whom the money passed, the quality of Gemini's regulatory status, the prestige of Genesis's institutional reputation, the prominence of Digital Currency Group, did not constitute a guarantee. It constituted a reputation, and reputations do not pay creditors when the money is gone. The DCG Genesis Gemini relationship also illustrated the specific complications that arise when a regulated entity partners with an unregulated one to offer a consumer product. Gemini was a regulated exchange that had worked carefully to build its compliance posture. Genesis was not a regulated entity in the same sense. It was a lending company operating in the space that cryptocurrency occupied before comprehensive regulation arrived. The product that bridged them, Earn, existed in both worlds simultaneously, presented to customers in the regulated frame but dependent on the unregulated one. When the unregulated world collapsed, the regulated frame did not protect the customers who had trusted it. The regulatory response to the Genesis collapse was divided across multiple agencies and jurisdictions. The SEC's January 2023 charges against Gemini and Genesis for unregistered securities offerings were the most immediately visible regulatory action. The Commission's position that the Earn product was a security, that customers who deposited funds through Earn were investors in a product whose returns depended on Genesis's investment activities, and that this product required registration and disclosure under securities law, was consistent with the SEC's broader effort to apply existing securities law to cryptocurrency yield products. The charges placed both companies in the position of having to litigate or settle the question of how the Earn product should have been classified. The question of whether Genesis's communications to creditors, particularly after the Three Arrows losses, when DCG's promissory note allowed Genesis to represent itself as capitalized, constituted fraud or material misrepresentation, was a question for both criminal and civil investigation. The Southern District of New York, where the bankruptcy was filed, had jurisdiction over potential fraud claims, and federal prosecutors and the FBI were reported to be investigating aspects of the Genesis and DCG conduct during the crisis period. The question of whether the promissory note structure was merely aggressive accounting or something more serious was unresolved as the bankruptcy proceedings concluded. State regulators also became involved. New York's Department of Financial Services, which licensed Gemini as a regulated exchange, had oversight authority over Gemini's conduct in the earned product. The NYDFS investigation of Gemini's role in the earned product, whether Gemini had adequately disclosed the risks to customers, whether the product was consistent with Gemini's licensing obligations, was another front in the multi-agency response to the Genesis crisis. For Gemini, navigating the NYDFS relationship while simultaneously pursuing recovery for earned customers through the bankruptcy proceedings and defending against the SEC charges required managing multiple regulatory relationships simultaneously, each with its own timeline and its own standard of what adequate conduct would look like. The multi-regulator response to the Genesis collapse illustrated a structural feature of the American regulatory landscape that cryptocurrency had exposed rather than created: the overlapping jurisdictions of federal and state agencies, securities and commodities regulators, banking and consumer protection authorities, each asserting authority over different aspects of the same transactions and products. The earned product had implicated the SEC because it might be a security, the CFTC because the underlying assets included cryptocurrency derivatives, the NYDFS because the offering company was New York licensed, and potentially banking regulators because customers were depositing funds expecting to receive them back. No single regulator had clear and comprehensive authority. Each had a piece. The coordination among them, imperfect, delayed, proceeding on different timelines, was the actual mechanism of regulatory response. International dimensions of the case were limited relative to some other cryptocurrency fraud cases, because the primary actors, DCG, Genesis, Gemini, were U.S.-based entities operating primarily in U.S. markets and subject to U.S. regulatory jurisdiction. The major creditors included some international institutions, but the core legal proceedings were concentrated in the Southern District of New York. This concentration made the case more tractable from a legal perspective. There was a single primary jurisdiction in which the most important questions would be resolved. But it also meant that the resolution would be shaped by U.S. bankruptcy law and regulatory standards that other jurisdictions had not necessarily adopted for their own cryptocurrency markets. The international creditors who participated in the Genesis bankruptcy, institutions from Europe, Asia, and elsewhere that had lent through Genesis' OTC lending desk, experienced the specific strangeness of having their claims resolved by a U.S. bankruptcy court applying U.S. bankruptcy law in a proceeding denominated in U.S. dollars in a market they had entered because it offered returns unavailable in traditional finance. For them, the lesson extended beyond the immediate losses. The cryptocurrency lending market, whatever its presentation as a borderless and institutional-grade alternative to traditional finance, concentrated its legal risks in the jurisdiction whose regulatory framework its primary actors had been built under. The global branding of the cryptocurrency industry had, in the Genesis case, encountered the jurisdictional reality of U.S. bankruptcy. The bankruptcy itself, as a legal process, performed a function that is easy to undervalue when examining the case from the outside. It created a structured process for resolving an otherwise chaotic situation. Without the bankruptcy framework, the competing claims of dozens of creditors against a company with insufficient assets would have been a race condition, each creditor trying to attach assets before others could, with outcomes determined by legal strategy and speed rather than equitable allocation. Chapter 11 imposed order on the claims, established a process for negotiating the plan, and gave the court authority to confirm a resolution that all creditors would be bound by even if some had voted against it. The process was slow and expensive. It was also, in the specific circumstances of the Genesis case, the mechanism through which a resolution became possible. The information that the bankruptcy process surfaced about the structure of the DCG promissory note, about the intercompany transactions between Genesis and DCG, about the specific terms of the Gemini Earn product's channeling of retail deposits was information that had not been publicly available before. The combination of the bankruptcy filing, the creditors' committee's aggressive discovery requests, and the regulatory investigations produced a public record of how the Genesis ecosystem had actually operated that no prior disclosure had provided. This transparency, produced in extremis by the legal process, was itself a form of accountability, not for the losses already incurred, but for the decisions about how to structure yield products and manage institutional lending in the future. The Genesis collapse left marks on the cryptocurrency industry that were visible in the regulatory and structural changes that followed it. The yield product landscape, the network of platforms that had offered retail investors the ability to earn returns on cryptocurrency deposits, was largely dismantled by the combination of the 2022 bear market and the regulatory response. Celsius Network had gone bankrupt in July 2022. Voyager Digital had gone bankrupt in the same month. BlockFi had gone bankrupt in November 2022. Genesis followed in January 2023. By the middle of 2023, the major institutional cryptocurrency lending platforms that had defined the yield market in 2021 had either gone through bankruptcy or been substantially restructured. The category of product, earn yield on your crypto, had not been banned, but the institutional infrastructure that had made it scale had been destroyed. The Grayscale Bitcoin Trust, which was DCG's most valuable surviving asset, won its legal battle against the SEC in August 2023. The court ruled that the SEC had acted arbitrarily in denying Grayscale's application to convert the trust into an exchange-traded fund while approving Bitcoin futures ETFs. The ruling forced the SEC to reconsider the application. This legal victory, coming in the middle of DCG's financial difficulties, was significant. It preserved the value of the asset that most mattered to DCG's survival, and it set in motion the process that would lead to the approval of spot Bitcoin ETFs in January 2024, a development that transformed the accessibility of Bitcoin as an institutional investment product. For the cryptocurrency lending space specifically, the Genesis case contributed to the regulatory push for clear rules governing cryptocurrency yield products. The SEC's charges against Gemini Earn established that the Commission considered such products to be securities, a position that, if enforced consistently, would require yield products to be registered and disclosed under securities law, with all the compliance costs and investor protection requirements that entailed. Whether that regulatory framework would eventually produce a sustainable model for cryptocurrency yield products, or would effectively prevent such products from being offered to retail investors in the U.S., was a question that remained unresolved through the period covered by this account. The Grayscale victory's importance for DCG's survival was difficult to overstate. By August 2023, DCG's portfolio had been substantially diminished. CoinDesk was being sold, other assets had been marked down. The Genesis bankruptcy had consumed management attention and legal resources for nearly a year. Grayscale's Bitcoin Trust, commanding a fee on assets under management, was the clearest path to the ongoing cash generation that DCG needed to honor its commitments and fund its operations. The court ruling that forced the SEC to reconsider the spot Bitcoin ETF application was not just a legal victory. It was a financial lifeline that arrived at a moment when DCG needed one. The public dispute between Cameron Winklevoss and Barry Silbert had a legacy that was more personal and more ambiguous. Both men had been central figures in building the institutional cryptocurrency industry. Both had come out of the crisis with their organizations diminished and their reputations complicated by the events surrounding the Genesis collapse. The industry they had helped build had survived, But the specific model of institutional cryptocurrency finance that had dominated the 2020-2021 period, leveraged lending, yield products, interconnected institutional obligations, had not. The question of what would replace it and whether the replacement would be more durable was left to the years that followed. The long-running public dispute between Winklevoss and Silbert also illustrated what happened when institutional cryptocurrency disputes became personal in a way that traditional finance's norms discouraged, but cryptocurrency's social media culture enabled. Both men had access to Twitter, to media relationships, and to audiences that would amplify whatever they said. The dispute became a spectacle that the broader cryptocurrency community watched with a combination of fascination and discomfort. The industry's two most prominent institutional figures attacking each other in public, while the retail investors who had been harmed waited for the bankruptcy process to produce its accounting. The spectacle was not separate from the substance. It was part of how the crisis was managed, how pressure was applied and resisted, how the final settlement was reached through negotiations whose public dimension was as real as the private ones. The creditors of Genesis, the institutions that had lent money directly, the earned customers whose funds had flowed through Gemini, the various counterparties across the lending market, received in the final distribution a fraction of what they had originally deposited. The exact fraction varied by creditor class and by the timing and form of the distributions. For retail earned customers in particular, the recovery was meaningful, better than nothing, substantially less than whole. The gap between what they had deposited and what they received back was the final measure of what the Genesis collapse had cost them. The institutional apparatus that had made the crisis possible, DCG, Genesis, the lending market, the products marketed to retail investors without adequate risk disclosure, had been restructured and diminished. The losses of the people at the end of that chain were not restructured. They simply remained. The final distribution to creditors was also shaped by something unexpected: the cryptocurrency market's recovery through 2023. Bitcoin's price had risen substantially from the lows of November 2022, and many of the assets that Genesis held, cryptocurrency and cryptocurrency-adjacent instruments, had appreciated through the year as the market found its footing. The bankruptcy estate available for distribution was, because of that appreciation, larger than it would have been if the assets had been liquidated at the depths of the bear market. For earned customers, this meant that the ultimate recovery, while still less than whole, was more substantial than the darkest projections in November 2022 had suggested. The market's recovery did not undo the harm, it did reduce it, in a way that the people who had been harmed had no ability to predict or plan for when the funds first froze. Close your eyes one more time. On January 19, 2023, Genesis Global Capital filed for bankruptcy. $3 billion owed. $900 million of that from ordinary retail investors who had deposited savings through a Gemini product they thought was a straightforward way to earn interest on cryptocurrency. The bankruptcy process ran through most of 2023. The bankruptcy plan was confirmed in early 2024. The final chapter of the Genesis story, in terms of the legal proceedings, if not the ongoing impact on the people who had been harmed, concluded with that confirmation. What the Genesis case illustrated, at the scale of billions of dollars and through the public drama of two of cryptocurrency's most prominent names fighting in open letters on Twitter, was the specific structural fragility that had been built into the cryptocurrency ecosystem during the 2020-2021 bull market. The interconnection of lending platforms, the circular obligations that made every participant partially dependent on every other. the yield products that promised retail investors institutional returns without disclosing the institutional risks, the promissory notes and intercompany transactions that allowed losses to be partially concealed while negotiations proceeded. All of it visible, in retrospect. All of it invisible during the years when it was accumulating. The case also illustrated a specific feature of how risk travels in a network of institutional relationships. It concentrates at the node with the greatest obligations to the most parties simultaneously. Genesis was that node. It owed money to retail depositors through Gemini. It owed money to institutional lenders across the industry. It was simultaneously the conduit through which retail yield had been funded and the counterparty through which institutional leverage had been extended. When both of its major borrowers, Three Arrows and Alameda, failed in the same calendar year, Genesis absorbed the impact of the entire network in which it sat at the center. The concentration that had made it valuable, the fact that it was the most connected institutional node in the ecosystem, was the same concentration that made its failure so large and so consequential when it came. The blockchain had recorded the transactions, the bankruptcy filings had enumerated the obligations, the regulatory charges had named the products. None of that documentation made the losses smaller for the people who had experienced them. A retail investor who had deposited $50,000 into Gemini Earn because it seemed like a safe and professionally managed way to participate in cryptocurrency's growth, had at some point during the bankruptcy proceedings to come to terms with the possibility that they might receive $30,000 back and be grateful for it because the alternative was worse. That is a specific kind of financial experience, and it does not resolve cleanly when the court enters its order and the legal chapter closes. There is a thread that runs through the cryptocurrency lending collapses of 2022. Three Arrows, Celsius, Voyager, BlockFi, Genesis, and it is this. The yield that was promised required risks that were not adequately disclosed. The returns were real for a time. The risks that made those returns possible were real throughout, but they were embedded in structures and relationships that were not visible to the people whose money was bearing them. When the risks materialized, the losses traveled through the invisible structure and arrived at the people who had the least protection against them, the retail depositors at the end of the chain. The specific form of the Genesis collapse, a parent company's promissory note deferring losses, followed by a second crisis that made the deferred losses unserviceable, followed by a public fight between two prominent founders, followed by a bankruptcy that took more than a year to resolve, was in some ways unique to the specific institutions involved. But the underlying structure it revealed was not unique. It was the structure of every undisclosed risk, invisible in the good times, material in the bad ones, and catastrophic for the people who bore it without knowing they did. Now let the weight of those numbers settle. $3 billion, 109 creditors, years of legal process to apportion losses that should never have existed. The record is made, the process is concluded, and here in the quiet, there is nothing left to calculate, only the slow breath, only the dark.